Time now for On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back again, of course, with Gavin Graham. He's our featured guest. He's also contributing editor at the Income Investor and Internet Wealth Builder newsletters. And Gavin, you're going to talk about exposure to the mega cap tech sector. Investors and viewers who have been long this sector for a couple of years are glad that they've been long. We continue to get a lot of questions about stocks like NVIDIA, AMD, Microsoft on our market call program. You believe, however, now's the right time to dial back some of that exposure.
Indeed, I do. Although, of course, I was saying that earlier in the last few months, and that would probably have been a little premature because, oh, look, NVIDIA's doubled again this year, and Microsoft, Meta, Alphabet, Google, are all up sort of 20 to 30% again. However, you ought to be taking some profits because the valuations are somewhat stretched. Not that that necessarily has mattered too much, but the fact is that the market's getting narrower and narrower. Interestingly, of the Magnificent Seven, Apple and Tesla are both actually down for the year, largely on the back of lower Chinese demand for their products, which is government dictated. And if there were to be any disappointment in terms of earnings, the market is punishing things pretty quickly. But even if not, you're probably well overweight in the large cap tech stocks. So why don't you actually lock some in until June 26th, I believe, Paul? It's still only 50% of your top marginal rate on capital gains before the capital gains tax increase to 2/3 goes into effect. So you've actually got this window a month or so, and you'll be paying less tax on the capital gains you will have on these positions, and buy some stuff which actually has been doing pretty well too. If you look, they haven't gone up as much as the mega cap stocks, but gold and silver, as you were remarking off the top of the program, in terms of silver bet over $31 an ounce, gold's at $23.80 or whatever, new all-time highs for gold, and we're a breakout for silver. So if you were to buy some of the larger gold mining stocks like Agnico Eagle, Pan American Silver, Franco-Nevada, all of which are recommendations in the Internet Wealth Builder, you'd actually be buying companies with excellent balance sheets, paying you a reasonable dividend yield, which is linked to the price of a precious metal, done some big corporate deals, Agnico and Pan American between them, split up Yamana's operations, Pan American taking the non-Canadian stuff and Agnico getting the other half of the big Canadian Malartic mine. And they're still below where they were back in 2021 when gold was, breaking out through $2,000 an ounce. This seems to be a pretty attractive area to be. And oh, by the way, with economic tensions and the like, these generally have tended to be a bit of portfolio insurance, safe haven. So worth looking at from that point of view as well. And
we've been looking at graphs of stocks like Agnico Eagle and Pan American as you've been speaking. All of them have rallied very, very sharply since earlier this year. There's Franco-Nevada, also has rallied a little less dramatically so than the others. The rally began for all of these stocks and the metal gold in late February. You favor the mining stocks over the metals themselves, exposure to the metals themselves. Why?
Because they're leveraged, an operationally leveraged play on gold. Every rise, every dollar increase in the price of an ounce of gold or silver effectively drops straight to the bottom line of the gold miners. In previous gold bull markets, which is the 1970s or the 2000s, gold, silver miners went up 3, 4, 5 times as much as the metal itself. And the metal itself actually had really, really good returns. Just in the 2000s, it went from $250 to $1,850 an ounce in a decade. But the miners did even better than that. They've been lagging in this rally over the last a year, 18 months or so. Very unusual. They're probably as cheap relative to the price of the metals as they've been in 15, 20 years. So it would seem to be, if you agree with the bull case, these are the way to play it rather than the metal itself, although the metals themselves are doing pretty well too.
Why don't we finish with just some quick thoughts on silver? It gets a lot less attention than gold, but the rally there has been very dramatic.
It has, and it's sort of the leveraged version of gold. When gold goes strongly, silver goes really strongly in both directions. It's much more of an industrial play. It used to be photography, although that's virtually dead now, but things like solar panels are still a major driver in the way that that's not the case with gold, although you do have a little bit of electronics. But obviously, again, with the green revolution, the demand for solar panels and the like is going to continue growing. But silver also has been, cheap relative to gold, and when it goes, it really goes strongly. So if you were, again, a believer in this story, this is perhaps the most leveraged way, operationally leveraged way to play it.
Thank you so much for joining us on Trading Day. While our U.S. counterparts rest, we're taking stock of the tech rally, which has, maybe after taking a bit of a hit in the month of April, certainly has found its sea legs once again. The Magnificent Index at record highs, ditto for the NASDAQ. And no rest ever for our next guest. Dan Ives, Managing Director and Senior Equity Analyst at Wedbush, joins us now. Dan, thanks so much for being with us. So what's the sentiment right now on the street? I mean, how much did conviction get sort of shaken in April, and how much was it restored in May?
Yeah, I think extremely restored in terms of the earnings. I think that's ultimately what we saw, is that the AI revolution, based on the godfather of AI, Jensen, NVIDIA, what we saw from Microsoft, Google, and others, this party's just getting started. And I think that's the sense. That's why right now, over the weekend, I saw a lot of bears in hibernation mode.
And what are they saying? Let's talk about NVIDIA, because it all kind of starts there. That's where all the demand is flowing. And if I do hear bearish comments that's on NVIDIA, it's that what happens after the hyperscalers are done purchasing their chips, inventing their own chips or making their own chips to do inference, basically run these large language models. What happens to business at NVIDIA?
But that, in my opinion, to that point, that won't be for another 2 or 3 years. They're the only game in town right now. So when you look at this demand, we're talking about $1 trillion of incremental spend. With NVIDIA, of course, 10-for-1 split, just another sign of just broader strength. They're going to continue to see acceleration. And that's what we're seeing from our checks in Asia, which is important not just for NVIDIA, but for the second, third, fourth derivatives of what's happening across software, semis. This is a 1995 moment, not a 1999 moment.
Well, I want to pick up on that point. Say, this is not going to happen for the next 2 years. Shouldn't a long-term investor then be worried about taking a position in NVIDIA if they want to hold? You think about holding Google for 10 years, Microsoft, Amazon, all these stocks. They've been such core buy and hold type of stocks. Does NVIDIA maybe not fit that bill because there is that cliff maybe coming up in 2 years?
Yeah, but to some extent, I don't view it as a cliff. I just view others will basically get overflow. AMD and others in semis. The godfather of AI, Jensen, NVIDIA, this is just a start. I mean, I view this more where Apple was in 2007, launch the iPhone. Because we're going to be, when you think about AI, these chips, they're the new oil, the new gold, in terms of where this is fueling. And I think many investors that have just focused on valuation, PE over the next year, they've missed the transformational tech historic growth names from Apple to Meta to Tesla and others over the last 20 years.
Since you brought up Apple, people always look to innovation at this company, and in a lot of ways they come after a product is already out and then just take it to the next level. That, I think, am I right, Dan, that that's the expectation at their developer conference in June? Do you really think they're going to deliver?
Well, I think you nailed it. A lot of times, innovation, they're not first to market. When you have 2.2 billion iOS devices, you don't have to be first to market. I think in a few weeks, and we'll be there at WWDC in June, that's where they're going to unveil the AI strategy. And what this is going to be is about the next generation of AI coming to consumers. Most consumers over the next 5-10 years, they will interact with generative AI through an Apple device. This is the start. I view it as kind of a pop the champagne moment as Cupertino unveils this.
What if it's just a licensing agreement? If it's with whoever it's with, if it's with Microsoft or if it's with Google, if it's with OpenAI, just to bring that technology to their existing Siri, is that good enough?
Yeah, based on all the work that we've done, I think there's a better chance of me playing the NHL for the Rangers in the playoffs than that happening.
Really? You think it's an in-house solution?
I think it's in-house. It's LLMs that they're going to introduce. OpenAI is going to be a big part of it. That's going to be almost a white label type solution, but they're going to have their own technology that they're going to introduce, as well as this is going to be an iPhone 16 coming out in September. That's why it's so important to get the popcorn ready as Apple unveils this.
You know, these companies, and we know this, are spending billions, and to some extent, investors have been okay with that. I imagine that at some point they're going to want to see a return on Meta's huge investments, for example, in AI. Do you have a timeline of when we start to see, I mean, growth should explode, right? I mean, it should move significantly higher. When does that happen?
I think middle 2025. So these companies basically call out 9 to 12 months to spend and then start to show the evidence of that. I think starting middle 2025. For the enterprise, that's right now front and center. Microsoft, NVIDIA, Google, we see on the cloud, Amazon, ServiceNow, Oracle, among others. The consumer piece, 2025. But if I look at Meta, Zuckerberg continues to play chess, others playing checkers. That's the smart move, laying the foundation for what's really going to be the next decade of growth.
And I know everybody says that, and I know you say it, and I use ChatGPT, and it's cool. I'm still using Google for a lot of things, and it's been more than a year that ChatGPT has been out, and Google's market share is virtually unchanged. When, is that a problem? Am I expecting it to happen too soon?
Yeah, I think when it goes to Microsoft and OpenAI, right now the golden goose is enterprise. It's really not about ChatGPT. It's Copilot. It's all these use cases that are being built on their Azure and on their foundation and stack. When we talk about ChatGPT and what we're seeing going forward, that's where Apple, I think, unveils something that could be a game changer. I think many are going to be looking at that, and that's going to be, I think, a next level in terms of how consumers will interact from a ChatGPT perspective.
Canada and the US are collaborating to invest in Canadian mineral exploration companies, and the idea is to secure supply of these so-called strategic metals. It's a broader governmental effort here to strengthen the North American critical minerals supply chain amid the threat of an all-out trade war with China. Of course, China has been pretty restrictive over the past few years with its rare earth exports, for example. Our guest is the CEO of one of those companies, Fortune Minerals. It's received about $16 million from Canada and the US Department of Defense. It's working on a cobalt, gold, bismuth, copper project in the Northwest Territories, and there's plans to put a processing plant in Alberta. We're joined by Robin Goad, President and CEO of Fortune Minerals. Thanks very much for coming on the show, Robin.
Well, good to see you again, Andrew. It's been a while.
Just remind us, this mine you'd like to build in the Northwest Territories, how much of the value, roughly, of the output would be cobalt?
It really depends on your price assumptions. Right now, cobalt prices are low, gold prices are quite high, but using our base case price assumptions, it's about 50% cobalt, 40% gold, about 10% bismuth, and a little bit of copper. But we expect that as we're mining the project, the ratios will change. Metal prices go up and they go down, and we have a counter-cyclical gold hedge.
That's interesting. What do you mean? The gold price would tend to be strong when the other metals drop?
Yeah, typically, gold prices are often counter-cyclical, and we have over 1 million ounces of gold in the deposit. So the critical minerals often have price volatility. The 25-year average price for cobalt is roughly $25 per pound, currently trading at around $14, $15 a pound. whereas gold, where we are using in our price assumptions around 1,700, is currently something and went through 2,400 just last week.
Now, tell us about this plant that you want to put in Alberta, because you have a potential deal in which you'd process material from Rio Tinto as well, material from Utah. So how much would the Alberta plant cost to build?
About $350 million is our current estimate. And there's a very good sort of analog to what exactly we're proposing to do with Sherritt. Sherritt's been operating a very similar hydrometallurgical process plant in the same jurisdiction for 65 years, and it's been processing multiple deposits. The cost of vertical integration is very high. And so if you can get some more materials going through that plant, then it spreads the cost out, both on an operating cost basis, but also on the capital cost. So our base case assumption is it will be processing concentrates from our planned mine and concentrator up in the Northwest Territories. But we're also working with the Kennecott smelter in Utah, where they have some residues containing cobalt and bismuth that can be processed to intermediates, and then we would do the final processing in Alberta.
You must get this a lot, but you probably saw Vital Metals. They were going to build a rare earth element plant in Saskatoon. They got $5 million apparently from Ottawa, but they declared bankruptcy in the middle of last year, so they couldn't make a metal processing plant work.
Well, we've been at it for about 25 years, Andrew, so we've spent $137 million on this project to date. I'd say that we're very well prepared for what we're planning to do. We have test mined our project. We've pilot plant processed it. We just take the validation that we get not only from the governments, but also from Rio Tinto. I don't think Rio Tinto would be working with a company if they didn't feel they were confident that we had the process technology and could work in collaboration with them.
It's interesting. Back in the Second World War, the Americans invested heavily in Canadian metal. I mean, obviously there were uranium operations in Elliott Lake, Ontario, but also they put a lot into aluminum production in Quebec. So that was a wartime, of course. We're not in a war, but we're in something like a Cold War in terms of trade with China.
Yeah, that was a very interesting story in CBC, which we read as well. I didn't realize that the American government had contributed to the financing for the aluminum processing facilities there, but also the Alaska Highway was also an American investment. But yes, we've got some various serious supply chain risks associated with, and I would use the sort of standard definition for critical minerals being metals that have essential use in manufacturing, defense, new technologies, cannot be easily substituted by other metals, but their supply chains are at risk. And if we take cobalt, for example, you've got 77% of the mine production controlled in the Democratic Republic of the Congo. We've got about 54% of that mine production controlled by China. And then China also controls 80% of the refining of cobalt. Bismuth, very similar scenario where you have about 80% of the global production controlled in China, 60% of the world reserves. If we're going to be able to participate in these new technologies, particularly the transformation to electric mobility, we're going to need to have geographic vertical integration. In other words, raw materials being mined in Canada, being put into precursor materials, put into cathodes, put into batteries, put into cars, all within the same jurisdiction, with supply chain transparency and also custody of control of the metals right through to the production of the value-added products.
Can I just ask about your balance sheet? Apparently, at the end of Q2 of last year, you had something like $8 million in debentures or loans maturing at the end of 2023. And one analyst said that there was an urgent need for refinancing. I'm sorry, we've only got 30 seconds. Did you deal with that?
We had a couple of debts last year. One with probably our longest and strongest supporter, who has deferred that debt till next year. We're in, I think all junior mining companies were in very serious financial difficulty over the last couple of years when the capital markets have been closed. It's very gratifying to see that they're starting to turn now.
Celsius, which grew its revenue, profit, gross margins in the first quarter. The company credits the performance to growing its sales and marketing efforts, its partnership with PepsiCo, and attracting new customers in the U.S. and around the world, including in Canada, where it officially launched earlier this year. And investors have taken note, pushing the stock up over the past year. For more on Celsius's business, its plans in its home market, as well as here in Canada, we're joined by John Fieldly. He's the CEO of Celsius. John, thanks very much for your time. Appreciate it.
Thank you. Glad to be here.
This is a brand that people are increasingly seeing on store shelves, and maybe you can give us the backstory on why you believe that this brand would be a successful one in an already competitive field.
Yeah, I mean, when you look at it, we're really capitalizing on three of the fastest growing trends in food and beverage. Everyone wants better for you ingredients, but they don't want to sacrifice flavor or taste. We feel we have some of the most refreshing energy drinks out there. Number two, we want more function in the foods and beverages we consume. We bring this functional energy. And then number three, health and wellness is a mega trend affecting all of us and has gone mainstream. And we were born in the health clubs and gyms, vitamin shops and GNCs, and now positioned for the health-minded consumer that's out there. And it's exciting times. We're disrupting the energy category, bringing new consumers in, and having our mantra is about living fit and living healthy and bringing that essential energy.
So, John, what's the breakdown between working on the product that connects with a consumer and also the marketing push? What's the breakdown on how you spend your time?
Yeah, well, I think you got to have a great product. Number one, we have great ingredients, 7 essential vitamins, vitamin Bs, with ginger, guarana, biotin. When you think about marketing, it's very important to talk about not only the features and benefits, but we're all about a lifestyle. And I think that's where we're connecting with consumers in a much differentiated way. When you think of traditional marketing, it's for a specific need state or a usage occasion. And what we're doing at Celsius, it is a lifestyle, bringing that essential energy to live life to the fullest. And we do some of that with some major properties this year. For the first time, we partner with F1, with Ferrari, who just won in Monte Carlo. I was very excited there at the race last weekend. We partner with MLS, Major League Soccer. And we have an Essential Vibes tour, which really connected with music and culture, which is exciting. And also college and university is a big push for us as well. And we got some great college and universities, ambassadors all around North America.
You know, one of the other big questions that comes up with younger, fast-growing drink brands is placement on store shelves. We mentioned your important partnership with PepsiCo. Can you explain to our audience how it works and what it's allowing you to do?
Yeah, I've been with the company now 13 years, and shelf placement is so critical, especially competing in the cold placements like cold coolers at major retailers like Couche-Charge, Circle K, 7-Eleven. Those are the likes. It's very difficult to stay on shelf when you're in those coolers. So having a great distribution partner like Pepsi, who allows us to stay in those cold boxes, as we say, and be in that bullseye zone in the cooler. So you can do a lot of marketing, but if consumers, you're not disrupting the point of purchase and there for the consumer when they're looking for an energy product or your product, you don't have a chance for the sale. So one thing we know is as we've gained great distribution, we're getting more cold placements. We got refreshing flavors. And once consumers try, they continue to buy because the product tastes great, makes you feel good, and we have some great innovative flavors out there.
So as you expand in more markets around the world, and I alluded to the fact that you expanded into a market like Canada as well, is there anything more you can tell us about the adoption, just to give people a sense of the growth curve for the company right now?
Yeah, well, we talk about shelf placements. Retailers, it's very difficult when you have a consumer products brand or company. You can get on shelf, but if you don't create that consumer pull, you'll be off that shelf very quickly. Retailers give you on average 3 to 6 months to show you warrant that shelf space. So those are the things when we're entering new markets. We focus on building trial, awareness, and ultimately loyalty. We focus on gyms and health clubs, the fitness community, as well as the next generation energy. What's interesting, when you look at Gen Z, college and university students, we're driving a lot of the category growth in the U.S. right now, over 47% of the growth in the category. And if you remove Celsius out of the energy category in the U.S., the category wouldn't be growing. So it's quite interesting where Celsius is placed and where we're headed. And in new markets, we're taking a methodical approach when we enter, really to build that loyalty so we continue to drive pull off that retail shelf. So we warrant more available, great tasting flavors on shelf with all the great retailers out there.
And then just to clarify as well, because here in Canada, like the caffeine count in the drinks, can you just remind us how it works as you're moving into new markets and figuring out that math as well?
Yeah, when you enter new markets, there's a variety of different regulatory requirements. We're fully compliant. The caffeine in an average Celsius is right around about 2 coffees of your average cup of coffee, and actually less than the average, coffee house, major coffee houses that are out there.
So you obviously had to adjust for that in a market like Canada as well. It feels like investors are also having to adjust to at least in terms of the market value of Celsius, a larger business. We talk a lot about this with these high growth businesses that move very far, very fast in the eyes of the market, and it's been a home run over the last few years for investors. But increasingly at this stage of the game, and we even see it over the last year with the stock price, things start getting a little choppier. People ask questions about the rate of sales growth going forward. When you talk to investors right now, what's coming out of those conversations?
Yeah, I think when you look at the opportunity here, you look at, there's 2 major players in the categories today. Red Bull and Monster, great brands. They control about 70% of the category on average. Really great products, but things are changing. Consumers are looking for differentiated products, and that's what Celsius is really connecting with. We're connecting with the health-minded consumer. We're connected with Gen Z, new consumers coming into the category. So the group, when you look at the growth trajectory, it still remains. We think there's massive opportunities. We just had the largest resets in company history. We're entering new markets. It's an exciting time for us. We just put up record revenues and profits and gross profits on Q1. So we're really excited. We got great innovation coming this summer. We're building our plans out for 2025 and beyond. I don't think we could be better positioned than what we are today.
All right, today's bank stocks are going in separate directions. BMO and National out with quarterly results. As I mentioned, BMO is a key drag on the TSX right now, while National continues to outperform. Both of these banks, though, increasing the dividend, and this stands in contrast to what we saw from Scotia yesterday. Scotia, in fact, typically increases the dividend around this time of year in the second quarter. They opted not to do that at a time where they say dividend growth will resume in 2025. Now, this speaks to storm clouds that are gathering and hanging over this bank. And I think one of the great ways to talk about this is through BMO's results. Adjusted cash earnings per share falling a little bit more than investors were expecting, down about 10%. The miss was primarily due to lower revenue, but higher provisions for credit losses. Investors were trying to get comfortable about what is driving those provisions for credit losses higher. We also saw an increase in some impairments that was a little bit higher than what we'd seen from some of the other banks. So the sell-off is actually accelerating. We're seeing it down about 8% here. On the conference call, executives were talking a lot about just the environment and how much it has shifted with respect to interest rates. The fact that we walked into the year expecting several rate cuts by the U.S. And several by Canada, and executives sort of acknowledged the fact that we might not get any in the U.S. and maybe only a couple in Canada. So that creates a little bit more of a tepid environment. You heard that on the Scotia call as well, where Scott Thompson said even if we do get these rate cuts, it might not show up in the economy or as relief to the consumer until a couple of quarters from when the first rate cut is. So a bit of a lag effect there. Broadly, though, these BMO results seem to be spooking bank investors. This ahead of Royal Bank's results, which are tomorrow. National, as I mentioned, a bit of an outlier. Let's bring in Bloomberg's Christine Dobby. And for shareholder perspective, we've got Murray Leith of Odlum Brown joining us. Christine, why don't I start with you? The National results, let's just paint how different their results are compared to what we've been seeing from the rest of the group so far.
Absolutely, and you've seen that in the share price performance today as well. The bank delivered really pretty good results in all of its operating units. You know, its Canadian banking segment was down a little bit on those provisions for potential credit losses, but other than that, it had very strong results in capital markets, very strong results in wealth management, and the bank is being rewarded for it. It's a stock that has been rising throughout most of the year, and it's been delivering fairly consistent, good results.
You were on the conference call, which was around 1 p.m. Eastern time. What did analysts pepper them about?
You know, I think provisions for credit losses are a big factor on everyone's mind, despite the fact that National Bank did perform well in the quarter. But as you were just saying about BMO, you know, this is a widespread issue that's affecting all of the banks, and it is something that you know, as you said, everyone came into the year expecting rate cuts a lot sooner, and now we're at a scenario where there could be, you know, 1 or maybe 0 in the U.S. and 2 to 3 in Canada, and that's really affecting the outlook for credit for consumers and for businesses, and it's a huge topic for the banks.
Absolutely, and maybe in some ways overshadowing some areas of strength, right? BMO's results, they saw big growth in their Canadian banking, capital markets, wealth management. I know the U.S. was a little bit weaker. On those provisions for credit losses, I mean, are they just being maybe extra conservative, more conservative than the other banks, or are there maybe more credit problems at BMO?
So one thing that was interesting from the BMO call was that, you know, executives flagged how there were a handful of particular impairments that were significant and that really increased credit loss or provisions by an outsized amount. So those were maybe unique situations that don't indicate widespread credit problems across their portfolio, but they did have a big impact on the PCLs for this quarter. You know, that one thing that has come up is that there is particular pain in BMO's commercial loan book in the United States. So that is dragging them down a bit further. But yes, as you said, it really overshadowed the rest of their results, it was a fairly strong quarter across the board. And their shares have just been really heavily punished for that today, and they've been downgraded, as I'm sure you've been talking about, despite, you know, performing fairly well overall.
Desjardins downgrading today. I think it's interesting that against that backdrop that they chose, Christine, to increase the dividend, because that's something that Scotia opted not to do yesterday.
Definitely, yes. Scotiabank's taking more of a cautious approach there. They still have the DRIP discount on their dividend reinvestment plan, and BMO. Well, to be fair, BMO's capital level rose again, so they did increase their dividend. Like I said, it was actually a fairly strong quarter, except for this. The PCL overhang, and I think the commentary from executives that this is going to persist for the next two quarters, probably for the rest of the year, has what's really what's sort of spooking investors today.
Thanks so much. That's Bloomberg's Christine Dobby for a look at the results themselves. Let's get to shareholder perspective. We've got Murray Leith of Odlum Brown joining us. Murray, it's not every day that we see a Canadian bank drop 8%. Does that speak to the maybe tolerance or intolerance of investors these days when it comes to any sort of credit unpleasantness?
Perhaps. I think one thing that people might not realize is that BMO was the most popular bank coming into today. 14 of 17 analysts had a buy rating on it, and that was more than any other bank had buy rating. So the disappointment and the shock on the credit quality front caused a really severe reaction on what has been a generally a tough day. So we don't see moves like this in Canadian banks very often.
Now the question is, what do you do? Is it a easy buy the dip opportunity, or would you be cautious?
Well, our clients have owned banks for years, decades, and they've been fabulous investments. They're great businesses. It's an oligopoly here in Canada, so they're very profitable. Balance sheets are very strong. They're very well diversified. They pay great dividends that are dependable and regularly get increased. So they're great long-term holdings. I don't know that they're going to be as good of businesses to own over the next 10, 20 years as they were the last couple of decades, but I still think they'll be among the top businesses in Canada in terms of stocks to own. Now that's the long term, and we're long-term investors, and if you got huge capital gains in it, you don't want to be trading in and out of them. But we've been advising people to be underweight the Canadian banks. They are cheap compared to historical norms, but they're cheap for a reason. Canada hasn't had a credit cycle, a housing cycle for 3 decades. Our economy is weaker than the U.S. economy, in large part because our consumers are a lot more levered. We have a lot more exposure to variable interest rates. Our houses are expensive and unaffordable. So Canada as a whole, our economy is more vulnerable, and a lot of that's discounted, but there's a risk that, it could be tough for a few more, for a number of quarters. And, I think that's what people heard today. In general, investors, it's been a great year for stocks in general. U.S. stocks are up 15%. Canadian stocks are up about 6%, which isn't nearly as much, but that's still not a bad number. But people have been discounting the Goldilocks scenario. And, things could be tougher economically in Canada, and that could weigh on the banks. So we think you still own them, but we're underweight. We've been preferring other areas of the market, and that's served us well. Our model portfolio here at Odlum is up 15% for the year to date, and that's on the strength of stocks in other areas of the market that we favored.
And I'm going to ask you what those are. But first, I want to get perspective on that point that you made, that the next couple of decades for the banks might not be as great as the past couple of decades. And I think for people who are long-term shareholders feel like, well, we've seen this before, and every pullback is an opportunity to add, because historically it has been. And it sounds like you're trying to communicate we're in a totally different era now.
I wouldn't say totally different. Maybe I'm trying to get cute and time these things better. I think we'll look back in 5-10 years, and the banks as a group, and probably all of them individually, will produce good total returns, including those fat dividends. But I think one might want to be patient before, certainly moving back to an overweight position. And I think we have time. I think there's other areas of the market that can do better in the interim.
Let's talk about those other areas. What's your most preferred right now?
My most preferred stance is to be broadly diversified, quality companies. But, for a long time, it was own the best. Don't worry too much about price, ride the winners, and that was the strategy that worked. We're in a different interest rate environment, inflation environment, and I think price really matters. And what we've seen over the last number of years is that the valuation spread between the best and the rest has gotten wider and wider. And I think it's, just owning the best stocks, that's very popular. You pay a dear price for that, and I think it's going to be difficult to beat the market with such a strategy going forward. I think there's got to be a lot more focus on the trade-off between growth and the price that you pay for it. And so that's where we've been focusing our attention on. We own Mag 7 stocks, 4 of the 7 Mag 7 stocks, but we're underweight them modestly. Trying to find other areas in the market where there's a better trade-off between the price you pay and the growth that you get.
Did you find it?
Yeah, we're finding it. Like some of the renewable clean air and energy areas of the market, like Brookfield Renewable, the whole space was hugely out of favor, got really beaten up a few weeks ago. It's had a huge rally. So, averaging down on those things when the baby was getting thrown out of the bathwater has helped. We've been playing the aerospace theme by owning names like GE Aerospace, which makes jet engines, or TransDigm, which makes aftermarket parts for all the major airlines. airlines, those stocks have done very well as travels come back.
Let's talk about that renewables play, because that's also become sort of a quasi AI play as well, you know, on the expectation of a pickup for demand. And I'm curious how you think about that, and whether there should be a healthy dose of caution for people who think they're going to buy utilities for AI exposure, only to be run over if the U.S. 10-year yield, you know, crosses 5%, crosses 5.5%.
It all comes down to price. And, you know, I think the utilities were, you know, discounting an expectation long ago that rates were going to stay higher for longer, whereas the rest of the market was discounting an expectation that they were going to cut 7 times this year. So the utilities overcorrected on the downside, were very cheap. And then people started to realize, like, hey, wait a second, electricity demand's going to go up a ton with all these data centers that are being built, and that's going to benefit the industry. So they were simply too cheap. But yeah, if interest rates went up a bunch, that puts pressure on the whole market and companies that pay dividends, perhaps more so. But it's the starting valuation that matters.